Good afternoon, everyone from Chicago. It is 12:03 p.m. Central U.S. time. This is another public AMA. Thanks for joining us. A lot of people signed up here. I see about a third have come in. So let's just give a couple more minutes to folks who are signing in, coming in about 2 to 3 at a time. I have prepared the questions, but you have the ability to take the mic. So let's just wait 2 more minutes and then we'll get started. Okay, folks. Again, it's 12:06 p.m. Chicago time on March the 3rd. Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not indicative of future results. We'll potentially be talking about statistics and so on. Just understand that statistics have a funny way of not working when you observe them. At least we tend to believe that. Make sure you understand and have done your own homework before using any of the information that I share with you. Everything I'm sharing with you is an opinion as a trader. It is not gospel. It's not written in stone, okay? Let's go over the rules real quick. The rules for this session is priorities given to participants who have submitted their AMA question in writing as part of the registration. You got a link to ask your question in writing, or you can take the microphone, type MIC in the GoToWebinar chat box in front of you, and I'll do my best to get to you. I prefer the mic questions. I prefer that it's a conversation rather than a sort of a lecture. So that's much better for me. One question per participant only. And yes, the webinar is recorded and will be sent to you as a registered participant, okay? So let's get going. Here's the list of questions. I have thrown them into different categories. I'm going to do my best to not preference one category over another, but what I'd like to do is possibly hit a question from each category until we get through them. My goal, believe it or not, is to get through this and have you all on your way within the next hour to an hour and 15 minutes, not longer. I don't want to hold you hostage here for a while. Let's start out with an execution question. Let's see. Be nice to have a moderator with me who can answer some of these questions. But Rohit is asking, I watch your morning trader bites, but then now that I have your IRT definitions and part of stage 5, would like more of discussions on your thought process of an actual live trade? What triggers to use to take trades with confidence without bookmap, since I don't have it? Now, if you're in the chat room, I do that on a regular basis. I do go over what's brewing, in my opinion, on the current action. I haven't been doing that so much lately because there's a lot going on that I'm setting up for new services and things like that should increase the quality of the service that we provide at stage 5. But I can't do that right here. It would take me probably an entire session to go through the idea, the context, the background, what happened overnight, basically do a new trader bite and what is currently happening and how I'm responding to it. So when we look at the action today here, I would have to narrate what has happened throughout the day, what is likely to happen now, how good of a job did the buyers and sellers do, and who is likely to be in control, what is likely to happen now, to arrive at the answer of, okay, this is my current bias, and then to wait for something to set up to stock a trade and walk through it. That is basically a an entire session in of itself. I do that sometimes. I did it the other day with Bookmap. Um, but it does. Your question is just too broad for me to handle in an AMA. Okay, great. Thank you. Richard from the chat room is volunteering. Richard, let's promote you. So here you are, Richard. There you go. You should be able to see the questions panel and everything. Thank you. I appreciate your help. So let's hide that. Let's go to the next segment, mindset. Can you please talk about the exact emotional transformation on the day, if you recollect, or during those days when you saw yourself effectively convert and graduated into that so-called consciousness competence stage 3, or better still, stage 4, in your case as a futures trader, as in the conversations with yourself as you derive the confidence to consistently take something out of the market each day. So, good question. I do remember, and I've been through it. I went through my first turn to consistency as a trader. The first time I went through it was in late 2001. In fact, just before 9/11 happened and the stock market closed. I was in equities. I went through it again in 2002 after a long break. I went through it again in 2002, fall of 2002, in equities as well. And then I switched to futures at the end of 2002, and then I really struggled with futures. I was in a prop shop yet again, but for futures here in Chicago at the Board of Trade, and I remember exactly what that process was like, and it was really difficult. I learned a lot from it though. There are many instances where I believed that um, it was not possible to do what I wanted to do. I was just not built for it. You needed to be someone special. You needed to be talented, and it's all this crazy fixed mindset. So what got me through it is that I was in a prop shop where there were people who were trading very large. People who are putting on a tremendous size in the bonds. This looks like my short is smoke, so it's time to bail on it. All right, well, that's that. Okay, and so there are very large traders, and there were traders that would come in and trade from 6 a.m. Chicago time right before the open, trade the bonds, and then switch to the DAX or the NQ or something, and then they were done by 9:30. So I knew it would be possible, and that really kept me in the game. And then the thing that got me on my game is that I just wasn't done. I just wasn't doing. I just wasn't doing what I was supposed to do, and I knew it. I knew that even though I was frustrated and I felt like the market owed me something for my effort, for showing up every day, for doing the homework and so on, I wasn't actually doing everything I'm supposed to do. And that's generally the issue with pretty much everyone that I run into. And so after I left the prop shop and did my own thing and started to back people, I went through the process with them at least a couple dozen times. And the process looks almost exactly the same. It involves people coming in and accumulating as much knowledge as possible and looking for a very or a guaranteed way to make money. And so the answer in their mind is in the technical side of things. Like, how do I get the indicator to cross over right at the right time so that I can, hang on, stock in a short here. So I can catch that big move before it happens and so on. But the truth is that even if you hand someone a um, fully detailed out plan and what they have to do and so on, in general, in my opinion, they just will not make money on it because the issues relating to execution and making the turn and being consistent and feeling like you can come in on a daily basis and do something with the market, that you have a fair chance, a reasonable chance of making money on a day-to-day basis, um, has to do with the way they view risk, has to do with the way um, they're managing their emotions. Emotions play a huge part in what we do, huge part. You know, you could talk about psychology and all this, but really, the difference between a guy who's just chipping away and is flat after commissions and costs and everything else, and the guy who comes in and it just loses and loses and loses, and they're in a clear downward trajectory, is loss control. So what you want to do is what you want to do as someone who's learning, and what you want to do as someone who's being taught even, is to attempt to take as many trade opportunities within your plan as possible, um, before you have to stop if you don't make the turn. And if you look very closely, you'll note that you and everyone you know who's in trading probably are great on a simulator, but are not able to do anything with a live market. And if you're great on a simulator, assuming you're not sitting there messing around and swinging 100 lots in there, averaging down all day on an infinite account size, um, if you're following your plan on a simulator and you're penalizing your exits and so on, because simulators don't mimic the fills in the market, and you see that you can make money, the reality is you have an edge. You just don't believe in it. And when you go live, your execution is completely fogged by your state of mind. And so once you start to believe, which that's where the light goes off, the conversion, as you call it, effectively convert and graduate from stage 2 to stage 3 or 4, essentially what happens there has a lot more to do. My guess is probably 80% of the effort has to do with your ability to manage your state of mind and to stay in the game versus your plan's ability to make money in the market. If you if you code it in a computer, chances are it does have an edge for many people. So you accumulate a lot of knowledge, and your focus as a trader, essentially, because it is a misleading industry, there's a lot of false advertising, false mentors, and so on. The idea is that all you need to make money is the perfect trading plan. But I'm here to tell you through experience, my own experience, that the perfect trading plan does not make money. It is the person who understands and is able to manage their uh, mindset and does not have limiting beliefs. In other words, they don't have a fixed mindset. They have a mindset of that the issues in between their ears, not with the market, not with their software, and so on. Although those can be issues as well. So that's the difference. The different stages of competence being asked, I'll go through them. Stage 1 is um, unconscious incompetence. You don't know what you don't know, and you think you know something, but you don't really know, so you still need to be taught what you don't know. Conscious incompetence is stage 2. That is, you've discovered that you've gotten your butt handed to you by the market. You've discovered that you don't know what you need to know, and this stage is the point. Usually, you get propelled from stage 1 to stage 2 through a large loss. The market teaches you that you don't know what you don't know. And so you get propelled into that stage by realizing that, oh my God, I just lost 40% of my account yesterday. Terrible trading. So people stop, they go and they study, and they're still incompetent, but they're conscious of the fact that they don't know what they're supposed to know. They generally, in stage 2, people seek help. Stage 1, they don't need anyone's help. It's easy to figure out because they believe their friend can make money, so can they, because their friend's, dumber than they are or whatever. Stage 3 is conscious competence. And at that stage, you are mechanically going through your process and are becoming somewhat of an expert. But it's a mechanical, left-brained, logical process. It is not an intuitive process. Uh, a bit like somebody who's relearning how to walk and consciously lifting their feet and putting one foot in front of the next and is focused on how the weight shifts and so on. That's conscious competence. So you're doing okay, but you have to do a lot of focusing. Stage 4 is where most people are, is where we all strive to be, which is unconscious competence, meaning you're just doing it. A little bit like walking day to day. You don't think about, bending your ankle and flexing your calf and then raising your leg and then bending your knee and putting your leg forward. You're not thinking about that. You just get up and walk. And you're very competent in that if I trip you, you can recover um, from that accident, right? That's conscious competence, stage 4. Most competent traders, good traders, professional traders are in this category, and they fall between stage 3 and stage 4. Stage 5 is transcendental competence or mastery, and the only thing, the thing about stage 5 is that you have someone who is competent but is able to interact and drop their consciousness into whatever categories needed to be at that level, to interact at that level. That's stage 5. Okay, and that's what the brokerage is named after. Not claiming that that's me or that's what the brokerage is. It's just the ultimate. So I hope I answered the question. The next category is technical. Jim, do you use market auction volume profiles exclusively for your day trading? Do you ever incorporate other indicators such as MAs, MACDs, BBs, Bollinger Bands, trend channels, and so on? I'm not exclusive on anything, but I do rely heavily on the profile. The profile helps me. It is okay. What you're trying to do as a trader is establish context all the time. That's your goal as a trader, is to constantly have good context of what the market is doing. Context means you have an understanding or a decent grasp on what is driving the market, who is in control over whom, and so on. That's what you're looking for. What supports that really doesn't matter, to be honest with you. It could be fibs, Bollingers, trend channels, MACDs, MAs. It doesn't really matter. I'm here to tell you it doesn't matter. All of it works and none of it works all at the same time. I say that all the time. You can make anything and nothing work in trading. It's just a function of mastery, like how good are you at that particular thing. So you can have people using the same 2 different charts for the same product and both make money or both lose money, okay? But for me, I use the volume profile because after just a ton of work with all those other things, fibs and geometry and so on, and market profile, I felt like a transition to volume profile gives me the best depth, and I see that the market responds not only in price but in volume. And so for me, the staples are, the key technical staples are this: statistics. Well, first and foremost, the profile tells me something, but it has to develop. if it's the current day. Otherwise, I look back at prior days. The volume profile tells me a lot about who's participating which prices, because this is, after all, an auction, and the market is either accepting or rejecting various prices. And then third, price action. I pay attention to price action as well, but not as heavily as those people who are studying price action alone. So hopefully that answers your question there. So that's the technical category. Let's go to the trade management category. Darren is asking about stops, a guide on how to use them with ES trading. So this is a tough category here. This is a tough thing to talk about because stops are necessary. I'm going to tell you that, and I want to be very clear that this is not what I'm recommending, but I don't use physical stops. So if you look at my trades here so far, hang on. I'm not using any stops. You don't see big orders sitting up top if I'm short, or below if I'm long. I tend to manage trades what I call actively. Generally, and I learned this early on, generally when I put a stop out there, I somehow switch and just wait for the market to take my stop out. And there are several pitfalls with not having a stop out there working. One being that if your connection is bad, then your position is naked in the market. When your internet connection drops or whatever, you have no protection. The other issue with not using stops is that people just lose discipline. They start to hope and pray that the market comes back. And then the other issue with stops is the amount of slippage, especially in a thinner product. Being an active manager of risk, I'm always looking to read the market as it goes on. That's why I have such a short-term chart here. I'm paying attention to all the rotations and how they work. See how these rotations are being shown here? I'm keeping track of how the market's rotating back and forth, back and forth. I'm still expecting the market to roll over and take out the 74 and a quarter. Therefore, I'm shorting 82 and a quarter right now and sitting here waiting for it. It's not been a good day so far. But in general, what I'm doing is I'm monitoring what happens. So I'll give you an example. Let me pull up my pen tool here, Epic Pen, so I can draw on the screen. So let's say the market drops. Oop, that's a terrible color. Let's say the market drops and I'm short, as I am right now. Now 82 quarter is my short. The market drops and then it chops around, then it goes back up, and then it drops some more, and then it pulls back up, and it continues to drop. I'm managing my stop from somewhere up here, and I'm starting to measure how the market reacts to this particular balance area here that it just formed. If my short is correct, I expect it not to get through this balance area if the balance area has resolved downwards. As it continues lower and forms another consolidation before it breaks, then I expect that this trade is not, if it continues to work, I expect that it should not, or I don't want it to get above the next balance area. These are areas that are called zippers. This is a zipper back here. That's a zipper. This sideways action. And as the market chops and comes back up, chops, and then drops again, this becomes my next area to manage my stop with, and so on and so forth. So I'm not using a trailing stop that is algorithmic, like every time it moves 3 points to move my stop 1 point or whatever. Maybe that works. Maybe that doesn't. But that's not how I manage things. For me, it is all about the auction. I cannot emphasize that enough. It's all about what is the market saying? What are the rotations saying here? This is the reason for this short that did not work. Market has had a big rotation here, 6 points, pulled back 1.5 points, and pushed to a double IB low. Okay, double IB low, statistically, again, past performance, not indicative of future results. Statistically, it has an 83% probability of at least breaching this by the end of day. By the end of the day, it's likely to breach that. That leaves me with a 17% probability that it will not. This is something that I'm willing to bet on. So what do? I look for consolidation, a push against a key level that I'm watching, which is the mid, but today's context, the mid is weak. So I look for the next consolidation up, which is this area here. And that's where I got short from. Held, waited, no scale outs, held, waited, and I ended up having to take a loss up here because I expect that it's not going to take out this consolidation zone, and it went into the consolidation zone, so I'm out. That trade didn't work, and re-entry up here. I'm expecting it to rotate down, chop, break the mid. If it breaks the mid and it pulls back, I'm adding to this trade, and I expect it to chop and continue lower, and eventually do a triple bottom, and then eventually break and hit our key target for the day, which is 74.25, and it hasn't done so yet. It's showing a lot of strength, mainly because our crude oil friend has been strong. This is a chart called this is an index chart that shows all the products that I'm following, the underlying equities that I'm following, and so on. And crude has been just strong. This starts at 8:30 a.m. Chicago time with the equity market. This is not a percent to yesterday's close, and crude has been consistently pushing higher, so it's causing us to have this issue with shorts right now, which is not working for me. But that's how I'm managing stops, to answer your question. Okay, that's a big topic as well. So that's trade management. Back to execution. Mike, can you talk about how often do you wait to see the IB range before initiating a trade on a given day versus taking a trade off of a price in the first hour, and how that fits your process? Great question. I don't wait for the initial balance to form. The initial balance, for those who don't know, the initial balance is these yellow lines. The initial balance is defined as the highest high and the lowest low in the first hour of trading. So you can see this low is moving down, moving down, but then when we get to 9:30, which is right here somewhere, it no longer moves down. And this line no longer moves up, and it's breached, and this is called a range extension. Once we take out the initial balance, we have what's called a range extension. And the theory behind the initial balance is that most major work, and there's technical proof that backs that up. All you have to do is draw a 30-minute bar chart with volume or a 60-minute bar chart with volume. You'll find that the first 60-minute bar is generally the highest bar of the day, and then the market slows down and it sits sideways through this period. This is why it's not great to initiate during this period, and it starts picking back up towards the close, and generally the close is lower than the open. So that leaves us with the highest volume and the highest amount of business happening in the first hour, and we call that the initial balance. So what this question is asking is, how often do I wait for the initial balance to form before I start trading? And I don't wait for it. Although if you are someone who is using tight stops and is looking to minimize their risk, it is best to wait for the initial balance to form and for the market to take shape and show you which side is taking control over what. That's always a recommendation to miss. So when I keep statistics on traders as part of our trade analyzer or whatever, we see that the riskiest time for a large number of traders, in my opinion, is that first and last hour, half hour of trading. So if they stay away from that and through the block from 12 Central to about 3 Central, generally that leaves you with an hour and a half or so, or 2 hours in the morning and an hour in the afternoon to really conduct most of your business. but I don't wait. Generally, if I'm waiting, it's because I don't have anything to trade against. There's nothing for me to do. So otherwise, I am gonna participate from the get-go. Down to the technical category, Vincent, I want to ask, what do you think about market being in overbought, oversold conditions? For example, many point out that now NYMO, NAMO, I have no idea what those stand for. I thought it was a symbol, but it's not a symbol, are extremely overbought. So is it New York something? Money flow or something like that? Are currently overbought market should pull back. Do you trade overbought, oversold conditions in your analysis at all? Like I said, I have no idea what those are, but I don't use technical indicators like that. Okay, this is an oscillator of some sort, McClellan. I don't use that. That is a lagging. I don't use. You notice on my chart, there's nothing that is a lagging indicator. There's nothing that is a lagging indicator. This may seem like one right here. This bright cyan colored indicator, but that's VWAP. It is not really lagging. It is not a period-based indicator. I don't use those simply because my focus is to stay with the auction. For me, overbought and oversold is a condition that does not exist in the market, because you can have, so I went through this with RSIs and so forth. You can have, let's say we put an RSI down here, and this is the 80% and 20% of the RSI. This is the overbought. So this is overbought, and this is oversold. Let's say this is, what I've noticed is these indicators, they move very quickly to the high, and then on trend days, this could move 20 points, and because of the law of averages, you have an oscillator that is kind of not moving that much, even though the market has moved another 15, 20 points. It looks like it's overbought and it should turn. And as soon as the market turns, it quickly responds. And you're like, wow, I didn't have a chance to put on a trade for that. I just don't believe in this. I'm not saying that it's wrong. I'm not saying you shouldn't use it. But to me, overbought and oversold is not a condition that exists within the auction process, because the auction can continue to go, can continue can continue to expand, and what's more important to me is to just keep track of, where are we relative to where are we relative to the auction. So for me, it's very important to keep an eye on how is this responding to the overall profile. Like, where are we versus, versus where the auction has been in the past. Right now, we're trading this area here. There's nothing overbought about this. This can continue going to 87 and a quarter, no problem. It has already pushed through the 82 and a quarter area again today. And so the next target is 87 and a quarter, and there's nothing overbought about it. It can continue going. And the other issue with overbought, oversold is that because the oscillator is likely to respond quickly to an adverse move, to me, to the oscillator, what looks like an adverse move and that it's done, to me could be a pullback to balance, a pullback to a high volume area like here, for it to collect more energy and then for a continuation. So if you watch those oscillators very carefully, you'll notice that that condition happens a lot, where an oscillator, looking back in time, reviewing it on a chart after it's done, looks like, oh my God, this is so obvious. This oscillator is going to work and I'm going to make millions of dollars. But in real time against the hard right edge, I find those misleading. That's just my opinion. So I don't use those things that you're mentioning because I don't believe that the market naturally has an overbought, oversold condition. Let's move down to the next category, trade management. Mike, If trading one contract in ES with an $8,000 account, what type of stop and profit strategy would you look to use? Again, this is dependent on so many things. So you gave me two things. You gave me your trade size and you gave me your account size. I'm missing the time frame of each of your trades. Like how long are you holding trades? If you're holding for seconds or whatever, then I would say your stop needs to be pretty tight and your percent win rate should be needs to be pretty high. If you tell me that no, I'm swing trading, then I would say $8,000 is absolutely insane to swing with, because you're dealing with a ton of leverage. You still have 15-to-1 leverage or something, and that could wipe you out pretty quickly. However, I can tell you this: take your time frame. Let's say you are trading on a 15-minute chart. Let's say with your $8,000 account, you're trading an 15-minute chart. If that's the situation, then what you need to do is study the 15-minute chart and figure out what is the rotation, what is the harmonic rotation that is built into a 15-minute chart. In other words, between the highs and the lows of a 15-minute chart, what is normal? And IRT, if you have IRT, there's a chart that is a study that gives you that information and tells you what is considered a normal rotation and what is considered an extreme rotation. Let's say you don't trade a 15-minute chart. Let's say you trade a 1-minute chart. So let's reduce this chart to 1 minute. It'll take a second here because I'm holding a lot of data. It takes a moment for it to recompute. Let's switch to a 1-minute chart. The way I would manage my stop, not only does it have to meet the criteria that would reduce my risk of ruin. So look up the term risk of ruin and understand what that's all about statistically, and what size you need to put on, what size stop you need to put on to prevent that. So that's one criteria. And then the other criteria is for a 1 minute chart, your rotations are going to look like, actually my Renko basically represents a 1-minute chart. When you look at the rotations, generally you'll see 4, 2, 2.5, 3, 2.5, 3, 3.5, 4, 3.75, 4, 2.5, 3. That's what the ebb and flow is. For most rotations of the ES, that's the general ebb and flow. Okay, what you want is your stop to be outside of those areas. So I'll give you an example. On a 1-minute chart, if the harmonic rotation, if the HR is equal to, and it's expanded recently, it used to be 2.5 to 3 points. Now it's about 3.5 points for a harmonic rotation. That's what's considered a normal back and forth. The issue with a stop that is anywhere inside of halfway through this is that your stop is likely to be in the noise of the market pushing back and forth, back and forth. You want to avoid that. So let's take a scenario. Here, you got long 77.50. Because from the point you got long, this could turn and go the other way from that high. You just got long, and that happens to be the high print. Your expectation is this is likely to push through and go down, most likely 3.5 points. You're likely to be wrong on this trade about halfway through that. So the minimum rotation, the minimum size stop, the absolute minimum size stop you want to have is 1.75 points. That's 7 ticks. Okay, that's assuming you caught the high of the move, and it's likely to push through the midpoint of the last rotation of this current rotation, and it's likely to be wrong. Once it breaks through, you're probably wrong. That's how I figure. Doesn't mean that it's right, but let's say that you're in the middle of a 3.5 point rotation and it pulls back and you get long here. You're leaving a lot of room for it to break lower again. Essentially, what you don't want is to be is to do what most people do, and that's two key things. Three key things. One, they're undercapitalized. they have too small an account for what they're trying to do, like trading oil with a $2,000 account. It's an example. That's basic insanity. You may make some money, but in my opinion, in the long run, the casino wins. You're probably going to lose your account. It's too much leverage. So under capitalization. The second thing is people wait too long. So in general, in order for someone who wants to trade long because they think, hey, this area is important to me, I expect the area this to be the low, and so I'm looking for it to turn, and then they wait for what we call confirmation. So they're waiting for a long time, and then they finally get in. So they leave a lot of room for the market to drop and take them out. And then the third thing is they're using too tight a stop. A lot of people use a 4-point stop, a 4-tick stop, or a 3-tick stop, and that's just too tight for the market conditions in general, especially in this high volatility. So what you want is not to risk, 5 or 10% per trade on an $8,000 account on a one lot. You don't want to do that. Clearly, your risk of ruin accelerates or is exponential in that case. The number of trades you can take is much, much lower before you have to stop trading. But at the same time, you don't want to use too tight a stop. So your answer depends on too many pieces, too many things, too many variables, the key of which is what is the minimum harmonic for your time frame? What is your account size? And you need to limit the amount you're risking per trade on your account. You want to be able to take 3 to 5 trades a day, and you don't want to wipe away the entire day's limit in one trade because you're risking too much. And then the other thing is, what's the reason for your entry, and when's your entry technically wrong? And you have to balance all those, and that becomes difficult to do with a smaller account size. Trade management's done. Let's move up to execution. The question is, assume you have an area of entry that you have planned prior. When you trade there, how far do you let it go against you? Do you just let it go until it's stopped to your pre-planned stop loss allowance? Have you experienced this and saw the market go back right after hitting my... I have experienced this and saw the market go back right after hitting my stop and ruins my confidence. How do you approach this in this situation? I hear about this a lot, and it's true that this is what happens. Again, this is a stop loss question, really. It's just a function of why am I taking the trade? Why am I taking this trade? And if the reason behind my trade has been eliminated, then that's when I need to get out. So this short here, the reason for this short is no longer valid. No longer valid. I'm shooting my target for this on this trade is the 83% probability of the double IB low, and it's pushing highs. That is not, in fact, in here, the idea is really null. I don't put a trade on and just say, here's my stop, 2.5 points. I'm long here. I'm going to put my stop at a fixed rate. I don't do that. In general, depending on whether it's in a high volume area, if I have an area of confluence, what I do is I break up the trade into eighths or quarters, and I build the position, but still maintain the same risk value and decide that way. And as far as, so my situation and your situation are going to be quite different, and everybody's situation is different, but my main thing that I want to leave you with regards to this is your mind is going to be very selective about what it remembers. It is the nature of the beast. If you go to my website, if you go to futurestrader71.com and go to resources and go to books, there's a list of books about psychology there. You might want to look at a book called the Chimp Paradox. And it explains how, in order to protect this, there's a primal part of our mind that focuses on preventing pain. Focuses on preventing pain, and what you'll end up doing is you'll place so much emphasis on the market hitting your stop and then turning the other way. And in most days that are sideways, and most days are sideways, there will always be a circumstance where you see the market move against you. So let's say you got short here for whatever reason. Let's say that's a short that you took, and that's your stop. And the market just took out your stop by a tick. You're going to feel the pain from that. You're going to say, it didn't work. But what happens is eventually what the market will do is it'll push, it'll come back, and it'll go through the area where you entered. It'll look like the market that trade has worked, and that's what you'll remember. What you don't remember is what it did actually is it went way against you. It could have wiped away 30, 40% of your account before it did that, and therefore your trade is not valid. What you do remember is that you got short, you put your stop here, it stopped it, you're going to stare at it for a while, you're going to see that the market, eventually turned and went through the area you got stopped and went through your entry and actually maybe even got to your target. That is still a trade that did not work. And so what is the natural reaction? Let's see if anybody can guess what the natural reaction is when somebody sees that. This happens all the time, by the way. When you see that the market stopped you out by a tick or two, and then eventually it came through your entry, which was up here, and it eventually went to your target, what do you think people do? They widen their stop. Yeah, they hold on to the next one. That's what they do. They say, my stop is too tight, let me put my stop here. And then it happens again. And so they widen their stop some more. And then they eventually say, I've lost so much money, who the heck needs stops anyway? And they let it run. And because they've lost so much money, even though the market would have normally hit their target, which is maybe 2-3 points or something, that's not good enough. Let it run through. I'm going to make all of my money back. And then it runs through, and naturally the market continues its trend, and it takes them out again, and then they have to go find a job and refund their account and so on. Don't do that. Just obey the trade. Your focus, if you're going to leave this AMA with anything, your focus should be steadfast and just sniper precision on the process. That's really important, and it's really difficult. It's really difficult to stay focused on that because your emotions are likely to get in the way because your money is on the line. Okay, so here's that example. We entered here because we thought the market's consolidating, is slowing down, is beginning to turn. We got stopped here, let's say, and here's the market at our entry. Oh my God, that trade, I should have hung on. Gosh, I shouldn't have used a 2-point stop or 2.5-point stop. Next time, you know what? I need to grow some cojones and hold it for a 4-point stop. So we're going to hold it for a 4-point stop. And the next thing you know, the market takes that out and then comes back again and does the same thing, except a 4-point stop at this point represents 10% of their account, and they're trading with a risk parameter that is 10% per trade, which means that their risk of ruin is exponentially high, because to balance the risk reward, you have to make 10% per trade or better. Making 10% per trade or better is not a very realistic target. So to me, it's about my goal. I have this plan. It's not some dreamed up plan. It is my plan. It's not my buddy's plan. And my plan works. My plan works. And my job now is to take that plan, practice it in a simulator on demo. Go to Stage 5's website and get a demo. You'll have it for 30 days, live feed, whatever. Or go to your whomever you're using and just use a demo there on live data, hopefully. Penalize your exits, not your market exits, but your limit order exits. Targets and things like that, and see if your plan has, and while you're at it, grab the S5 Trade Analyzer so you can keep metrics every day of how your trades performed. If your plan has an edge, stick with the process. That is what I would recommend. That is my opinion. Stick with the process and just follow the process. Think of it as, I did enough homework so that my job now is executing like a computer, except I don't program, and my idea is too complicated for a computer to program, to execute, so I'm executing it. But my process is to follow the plan as it is, period, rather than constantly modifying it, constantly micromanaging a trade, and changing your plan day in, day out, depending on the fact that it was painful watching yourself get stopped. Very valid question and a very, very common problem. So the bottom line is make sure you're not trading too tight and make sure your plan has an edge, and then just follow it. If you're not sure, make a commitment to trade the exact size with the exact risk parameters on a simulator. Be disciplined. If you cannot play properly and hold on to your discipline in practice, just like an athlete who's practicing for the Olympics, if you can't do it in practice, then I don't think you should expect to do it in real life. And that's just a fact. I know it sounds like I'm being mean or whatever, but that's, if you can't pull it off in practice, you're not going to pull it off in real life. So it's very important to stay disciplined. David, we have a mic question.
Hey, Morad.
Thanks for coming on.
My apologies if you've covered this already today, but so my question is, we don't trade, well, I don't trade the news. Try and stay away from the last few minutes of close, just in case there's some size going through. So my question is, how much weight do you give to the European close? And you can't use the words "it depends" in your answer.
Okay, so
challenge for the day.
Yeah. So are you trading the European market or are you trading the US market? But you're asking
US.
How does, okay. So I did a study on this, but it's a little dated. It's a little old now. I don't know. I'm suspecting that it's probably the same. But the European market in Chicago time closes at 10:30. That's 4:30 in London and 11:30 in New York, okay? And in general, what happens is you get this ledge. Actually, we see it today. So here's the 10:30 bar. You see how the volume drops off there? See how the volume drops off? Also, the average, the 20-day volume drops off. In general, the time to start being careful is about 15 minutes after, and this is based on a volatility and volume study on a 15 time slot basis that I think we all did in the S5 chat room. I think Hampton did it. It's like a heat map. Actually, I did it and then somebody else improved on it. It was a heat map that shows in 15-minute increments that looks at volatility. So what is the range of a 15-minute bar, and then the volume of a 15-minute bar, and then we see how that pattern drops. And what you see is the market generally loses a lot of activity at about 10:45 Central, 11:45 Eastern, 15 minutes after the European Open. That's when it starts to become that time where the interns trade, right? And so there is an effect, and it's quite a noticeable effect. So let me enlarge this so you can see it a little bit better. Hang on. So here it is. We're just looking at today, the most recent information. The European close is right here. So that's where the 1030 bar started, right there. The European close, this is the current day. The bar itself is the current day. These bars, these little thin bars, is the 20-day median volume for that time slot, And you can see how it starts to drop off, the 20-day. So today traded below the 20-day median volume for the 1030 till 1045 time slot. And it's a big step down. And if I scroll back this chart, so this is how much volume dropped. So that's what I would call, I would suspect that that's the European effect. But let's not draw a conclusion on a single sample. So yesterday we had some additional volatility, but in general, here's that bar, and here's the European close, the 15-minute after the European close. See how it drops off? And also the median volume over 20 days drops off as well between those bars. So you have, again, the highest volume in the first hour, usually the first bar, and it drops off, and then it starts to pick back up into the close. This is a very normal pattern for volume. This is a 15-minute chart, and these are 15-minute time slots, but we can look at it on an hourly. And I think, you have access to the definition. You'll be able to look at that yourself. But for me personally, I start to become more, I cut my size, like the losses I took today were about a quarter size, and I start to cut my size back after the European close, and I ramp back up during the closing range trade, which is 230 to 235 Central, 330 to 335 Eastern. Does that answer your question?
Yeah, that was part A. So like today, for example, if I see a strong push from in Chicago time from 10 to 10:30, if I see a strong push during the last half hour of the European market, then sometimes I see a reversal after the Europeans close.
Yes.
So today's a good example of that.
Yes, I see that as well. It shows up in this chart, in the index chart. So what we're looking at on the index chart is the Euro stocks and the DAX. So here's the DAX. It's this brown line that's highlighted right here, and the Euro stocks is this blue line. And you can see that we basically move in sympathy with it. Let me change the color. We move in sympathy with it. This is the European close right here, and you can see that the European close ended up closing lower. The DAX is lower, the brown is lower, and if you look at the S&P, which is, I believe, the dark, where the heck's the S&P? It's hiding. It's back here somewhere. The S&P will tend to move with that on the close as well, and then you get this little ricochet. You get that on the news as well, but we do have this reversal. We also have what they call the 930 reversal as well. You have right after the IB's in, there's generally a reversal across the board after the first hour of trading. But these are things that you can, kind of observe, but you need a sample size that is sufficient to draw a conclusion. And generally that is 200 plus sample sizes. So you're looking at almost a year. A year has 252 trading days, 254 trading days. You need to look at almost a year to draw that conclusion. And even if you did, I don't know if that's something you can trade off of, because essentially you would be just trading based on a stat alone, like a day stat or something. You need to still look at context and what the market is doing today versus what is done over yesterday in the last few sessions. Does that make sense?
Yes, sir.
I know that's a long answer. I cannot comment on the specific situation, but I know, and it's something that I've observed because I used to trade the DAX and the Euro stocks very heavily. It's something that I noted over time and have studied, and it is generally you want to kind of back off, ease off when the European close comes around. The European market does not control our movement as much as it used to last year when Greece was in the picture and so on. But it still has that effect. Volume does drop off once the European markets close. All right?
Okay, thanks, Murad.
Take it easy. Bye. All right, we're at an hour. We pushed to get as much answered as possible here. I'm going to have to cut it off here. I don't want this to run too long. I know there are many questions that have been answered here. Eli, how do you use the cash index chart in your trading? That's this thing. Essentially what this does is it's I watch it very closely on the open. On the open, and what I like to see on the open is how are things moving. Like the dashed lines are the underlying sectors, IBB being the biotechs. That's a big influence on the NASDAQ. But these other dashed lines, let's expand this to see what it is. The other dashed lines, for example, this dashed line is healthcare. It's showing healthcare is weak. This dashed line here is the financials, and it shows me very clearly, believe it or not, despite the whole mess, and I can divide these up, it shows me very clearly which sectors, which underlying markets are in control that day or for that time period. And that's important to me because a lot of times lately we've been moving with the black line, crude, black gold. We've been moving a lot with crude, and if somebody says, well, crude is dropping and the ES is not moving with it, I can take a quick glance and see if that is the case. The ES is this dark green right here, and I can see whether the ES is in fact moving independently or not. Let me make that a thicker than usual line here so I can find it easily. So I could see whether or not these are moving in sync or not, and so on. The treasuries, if treasuries are moving in the opposite direction as equities, the yen is moving in the opposite direction as equities, gold's moving in the opposite direction as equities, it tells me, and it's something that I covered in Trader Bites in the morning, that is the sentiment, the overnight sentiment. It tells me that the sentiment is that risk is coming off the table. Money's going from the safety instruments, the hedge instruments back into the equity market, and it gives me more confidence if my bias is long. That's generally how I use it. Anyway, that's the last question I answer. I am really sorry. I know there's always a lot that I don't get through, but I do my best. But it's important to keep these sessions short enough for people to follow along. Richard, thanks so much for helping me answer some of these questions, and thank you all for joining in. I will make sure that this video goes out to you today in case you missed the beginning or the ending or whatever. Good luck and take